with short selling, the timing of your idea can be obviously very important. How do you address this sort of unique challenge?
Well, I think one must be prepared to think honestly. And that means that one shouldn't become obsessed with a particular business or a particular sector or a particular entrepreneur. That is foolish. One must keep an open mind.
How do you cope with unlimited risk to the upside when taking a short position?
Well, it's not true to say that there is an unlimited risk, because if you wish to be completely technical, the fact is that for unlimited risk to impact, you have to work on the assumption that there is an unlimited amount of money in the world. But actually there isn't an unlimited amount of money in the world, and positions have a habit of topping out. And I personally am completely uninterested by brokers who keep ringing up to say this is the end of the world, you must do something about it. Indeed, my attitude when a position goes heavily against me, simply because the world's gone mad, my attitude is very much one of doubling the short position, not halving it. And of course that doesn't always work, but in the main it does, because people insist upon being excessive in views.
What about the risk of a potential bid? How do you protect yourself against that?
A bid? Well, in a sense, there is no protection against a bid. The terms are out, and then you've lost your money. I suppose your question is, if a share price is low and looks to be going lower, what are the chances of a rescue bid of some description? Well, that's a chance, and I don't think there's any way of foreseeing such a chance crystallizing. No, I don't think there is any way, but you just have to live with the result.
Okay. So this is going back to stops again, actually.
Yeah.
But could you make the use of guaranteed stops offered by spread betting to protect against this unlimited downside?
Well, I don't use them. It's not in my nature to pay for insurance cover, which is very highly priced. But there are other people who say, well, I couldn't sleep at night without cover. To which my reply is, well, you haven't been sensible about this. Your original opening position was too large to start with. That's where you made your mistake.
Suppose there are rumours of a takeover and I want to place a short with a guaranteed stop. Will the spread betting company still allow me to go short in that company using a stop loss?
I don't know. As I say, I don't use stop losses. I never ask for them. And in any event, that's not how they think about matters. They set a margin rate on a stock and persist with it. In fact, one of the funniest things about these firms of spread bettors is the chaps who set the margin rates for them are not really interested in shares. So they don't know what's going on as regards the underlying stocks upon which they are opining. A very good example of that, just in recent days, has been Afrin Energy, which you may have encountered across. Afrin is Africa Energy, you see. Ticker code AFR. Well, that used to be, because it was so frequently traded, on a margin rate of 10%. But for some extraordinary reason, as it entered its last weeks, the margin rate stayed at 10% when it could easily move 50% in a day. That was not a problem for those who accepted that that was so. But why the margin rate stayed at 10%, I don't know. Well, now, of course, the Johnny-come-latelys have raised the margin rate, or rates, to 50% on Afrin. Well, all I would say was, what took you so long, chaps? But anyway, it is now 50%, and I expect that as Afrin now stabilises, which I hasten to add it will, they'll keep the margin rate at 50%. And as a result, those who might come to go long on Afrin, although they're probably insane if they're thinking along these lines, but if they choose to go long, they will encounter a 50% margin rate. And therefore they'll think, well, they'll think of something else to do with their money. They get more bang for their buck elsewhere. And I suppose it might eventually, after a few months, occur to the margin rate men that perhaps it would be wiser to reduce the margin rate to something which reflects the new changed circumstances. But they never do it in advance of where an obvious change is going to occur.
What about, don't you tend to find that stocks generally rise in the long run?
Well, in a sense, stocks will always rise because of inflation. Although I would qualify that with the point that just of late we look to be heading into a period of deflation. How stocks will behave in those circumstances remains to be seen, but obviously stocks will tend to reflect inflation or general price levels. There is, of course, another point, which is that, as you may know, a Harvard academic, Mr. Tobin, I think he's James Tobin, I'm not sure, he devised, 30 years ago, the ratio which is called Tobin's Q, which considers the general level of share prices and the general level of the cost of replacing the assets that make up the share in question. And of course, where prices are generally high, managers of businesses are minded to go out and buy the underlying assets and sell them to the market, knowing that there will be an immediate uplift in valuation. And that is how capitalism works, and I don't see any chance of that ever changing. It never has in the past 1,000 or 2 years, and I don't see it going to change now. So there must always be, when share prices have a Tobin's Q above 1.0, i.e. the point where shares equal the underlying cost of assets, there will always be a supply of shares to come to the market. The mystery is how share prices have stayed up where they are. After all, it was in 1996, 1996, I beg your pardon, that it was in 1996 that Alan Greenspan said that markets were exuberant, irrationally exuberant, and he was basing that remark upon Tobin's Q. And I don't suppose at the time he said that it ever occurred to him that prices would get to where they have, because however irrational the Tobin's Q ratio was then, I would think it was at least 2.0. It must be at least 3.0, perhaps for all I know 4.0 now, and on Wall Street, and that strikes me as ridiculous. And therefore, just to say when stocks are generally overvalued because of Tobin's Q is a mistake, because we're looking at close on 20 years from 1996, and the fact is prices have not adjusted down. There was, of course, the major slump at the time of the puncturing of the dot-com boom, but even so, share prices did not generally then retire to the point where Tobin's Q was less than 1.0. And so, understandably, I and other people took the view that share prices were too high. Well, I'm even more of the view that share prices are too high. So that's my position as we speak today. Being a bear is naturally a sensible thing to be. I never thought for one moment that this extraordinary performance over quantitative easing could ever occur. Not that it would occur. I didn't say to myself, well, it might occur and will be conquered. It never occurred to me that it could occur. So I missed that.
Yeah. Right. Is there a predetermined limit to how long you can keep a short position open?
No, as long as you keep paying the charges, you can keep it open forever. Save possibly where the chaps who are lending stock to the market, which one has borrowed to maintain the short position, they themselves might want to have the stock back, either because they're working in cahoots with the management to artificially leverage upwards the share price, or because they want to sell the stock themselves. And if they lent the stock, they can't deliver stock when they eventually want to sell. So under those circumstances, you will get people calling for their stock back. And that's how it works.
And technically you could be forced to cover at any time. Are you having the shares you've borrowed called back? What about this risk?
Well, that's a risk you have to live with. The market terms are very simple. If stock is to be called back, your broker will contact you and say, look, you must now return the stock. Or sometimes they say, well, you've got a day or two's grace, but work on the assumption that you'll have to return stock. That you have to live with. Those are the rules. They've always been those rules. I've checked as to what went on, for instance, in America in the mid-19th century, where they've always had a grown-up attitude to capital markets. And the position was very simple. When you were called to have stock back, to pay stock back, then you paid it back. And the idea that you would try and and was just not acceptable. It would happen.